Welcome back to another episode of Give Me Some Truth. I'm Keith Poniewaz, a financial advisor here at Wachner Condon Financial, and I'm joined by my colleague Sil Michelin. Unfortunately, not joined by our colleague Stan Farmer, who's feeling a little under the weather today. So we hope Stan feels a little bit better. I have one kind of on the topic of podcasting, but not on the topic of the podcast today observation. Sil, every time we come in here, it seems like Dan has more buttons he can push before we get started.
I know. I'm a bit worried about the escalation here in terms of the amount of equipment that we keep buying. I don't know who's approving the budget.
Yeah,
that's what worries me.
He can tap a button here. He can tap a button there. He's got all sorts of buttons he can push now, and I don't know what's changed or if anything's improved, so a lot of buttons being pushed.
Send us feedback. Hopefully, it's supposed to improve the quality of the podcast. So please send us your feedback.
Yeah, I mean a lot of buttons being pushed, both literally and metaphorically here, literally and figuratively. The other thing that I was thinking about, this is more related to the topic of the podcast, is we're going to talk about IRAs today. And when I was a little kid, unrelated to IRAs directly, I don't know if this was with you, but I used to have every one of my friends' phone numbers memorized, right? You knew, oh yeah, my buddy, that his number was XYZ. You knew your parents' number. You knew this. You knew that. Now, with the advent of cell phones, everything gets stored in your phone. I can't tell you anyone's phone number.
I can't either.
Yeah.
I can still remember our home phone number from when I was 6 years old.
Yep.
I cannot tell you my wife's phone number right now.
That is impressive. Yeah. I still know fortunately my parents have had the same number since I was 6, so I can still remember that. Mm-hmm. I can remember a couple of my grade school friends' numbers. If you really pushed me on it, I think I could pull them up. But like you said, somebody's number currently, no idea. And I was thinking about that with IRA contributions. It's a place where computers have ruined our brain. Because, if you're just off the top of your head, okay, how much can people contribute this year versus next year to an IRA? Is it 6,000 or is it 7? Is it 6,500 or is it 70? I don't remember that as much anymore. And I don't also remember the exact upper limits. When I started, you had to practically memorize all of that for your tests. And now with, the advent of the computer, it's boom, you can Google it and pull it up and, probably much safer anyway than relying on your memory. And they change every year. And we're going through another period where the rules may be changing with the laws, the Secure Act 2.0 as it's referred to. But today we're going to talk with a very basic, kind of question that relates to those kind of contribution limits, those numbers, all of that, which is a lot of expats. One of the first, questions we get is either, how can I, save for retirement because I can't contribute to an IRA as an American, or I can't contribute to an IRA as an American outside of the United States as an expat, and that's just not true, right?
That's right. Yeah, I mean, and we hear it all the time from just clients or just people we talk to in the expat community. They have this idea that just because they live outside the U.S. or they don't work for a U.S. employer, they can't contribute to an IRA. It's not true, right? That there is absolutely no truth to that statement. So there are reasons why you may not be able to contribute to an IRA as an expat, and there are also reasons why you would not want to do it, even if you could. But there are no rules that would prohibit someone from contributing to an IRA just because they don't live in the United States. That rule does not exist.
And so I think to break down why you may not want to or may want to, let's just, I'm just going to lay out very quickly, the traditional IRA, what that is, versus the Roth IRA. And we'll start with the traditional IRA, and what I'll do is kind of lay out the traditional IRA and turn to you, Sil, to explain how expat life affects that, right?
Sure.
So if I'm an American, I work in the United States, I earn a living, and let's say my employer does not offer me a 401k plan, I can contribute, if I'm under age 50, up to $6,000 a year into a traditional IRA. The nice thing about that as well is I can take that money off of my tax bill. So say, because I like nice round numbers, I make $100,000 a year and decide in 2022, I'm going to take $6,000 of that $100,000 and contribute it to a traditional IRA. That means I'm only going to have to pay tax on $94,000. That's advantage number one of an IRA, right? It reduces my current tax bill. And related to that, longer term, one of the things that people often think about is, okay, I'm in my prime earning years right now, making a lot of money. In the future, my tax bill will be lower because I'll be in retirement and making less money, have less expenses. So one of the advantages of the IRA as well is putting money in while your tax rate is high, right, and taking out when it's low. Mm-hmm. The other thing related to the IRA is that any money in there will grow tax-free forever and ever until you have to start taking it out, essentially, which right now is 72, could change, right? So the other thing people don't realize is with the traditional IRA, when you pull that money out, it's not taxed at the capital gains tax rate. It's taxed at your income tax rate. So with that kind of in mind, that kind of brief overview, why might it not make sense in those terms to contribute to an IRA while you're living outside of the United States? Or why might I not be able to contribute to an IRA, a traditional IRA, while I'm living outside of the United States?
And so, going back to your example, you were able to make an IRA contribution for a very simple reason, because you had a salary. As you mentioned, you earned $100,000 last year. And that's really the one thing that allows you to make a contribution. It's the fact that you had what they call earned income. So you had employment income. And IRAs ultimately are a benefit that's available for workers in order to help them save for retirement. So the one thing that determines whether you're eligible or not for an IRA contribution is whether or not you have employment income. So it doesn't matter if that employment income comes from a U.S. employer or a German, Turkish, Australian employer. As long as it's employment income, it is earned income, you're allowed to make an IRA contribution. It's literally that simple at the core. Now, the issue with expats is that a lot of them use what's called the Foreign Earned Income Exclusion. So for anyone not familiar with the Foreign Earned Income Exclusion, it's basically a provision in the U.S. tax code that says if you collect income from a foreign source, from a foreign employer, for example, then you're allowed to exclude a certain amount of that income from your U.S. taxes. And so the amount is updated every year. I think for 2022, it's $112,000.
And it's indexed to inflation.
And it's indexed to inflation. Going back to what you were saying earlier, I mean, that amount has gone up so dramatically over the years. I still remember when the foreign earned income exclusion used to be $87,000, and now it's gone up to over $100,000, over $110,000. So it's going to change a little bit every year. But for 2022, I believe it's $112,000 per worker. And so if you exclude your earned income using that provision in the tax code, the Foreign Earned Income Exclusion, then in terms of figuring out if you're allowed to make a IRA contribution, you've effectively removed that income entirely from your U.S. taxes. It's as if it was no longer earned.
You're excluding it.
Exactly. The clue's in the name.
Yeah.
It's a complete exclusion of the income that you earn from your U.S. taxes. And so that's where I think a lot of the confusion comes from in terms of expat thinking they're not allowed to contribute to an IRA. It's not that they're not allowed because they're expats. It's just a function of how they're reporting their foreign earned income. And so, the foreign earned income exclusion is very popular. A lot of expats use it. People may not even know they use it. It's just
it really simplifies your tax filing.
It does.
It makes life a lot easier, and it doesn't necessarily make sense because you want to use an IRA to not take the foreign earned income exclusion.
Exactly.
Right? Because the other reason why it may not make sense, right? You may not want to is say, just again, I like nice round numbers. I make, say, $200,000. Why might I not want to then use that IRA? I can deduct it off of my taxes in the U.S. Why might I not want to do that if I'm living outside of the United States?
Well, so the main benefit, as you explained earlier, the main benefit of making an IRA contribution has to do with the tax deduction that you're getting, right? So that's really what's great about it, is you put in $6,000 and you can deduct $6,000 from your U.S. taxes. Now, that's a U.S. benefit, right? So it's a deduction that you can take on your U.S. taxes. The thing about most expats, and people don't always realize this, but most U.S. expats actually don't pay U.S. taxes, right? So people in the expat community obviously complain a lot about filing U.S. taxes because it's a headache and it's a burden and it's annoying.
And if you have a more complicated tax situation, usually you have to pay someone to do it.
Yes, there's that as well. But there was one expat accountant who told me this once, and it kind of stuck with me. He said, expat tax filing is really a huge data gathering exercise. And for a lot of expats, it's just about filing forms, making disclosures, sharing data with the IRS, but it doesn't actually result in any U.S. tax liability. And the reason for that is that oftentimes people live in countries that have higher taxes than the U.S., right? So I'm sure we have a lot of listeners in Western Europe, for example. Most of them would live in countries that typically have higher tax rates than we do in the U.S., right? And so whether or not you use the foreign earned income exclusion, or if you just claim tax credits, so meaning, say you pay 10,000 euros of taxes in Germany and your U.S. tax liability is $5,000, you have enough foreign credits to effectively erase entirely any hypothetical U.S. tax liability that you might otherwise have had. So, if you're in that situation where your net tax position is that you are a foreign taxpayer, you pay the tax rate of a foreign country, whether that's Germany or Spain or Italy, then you need to ask yourself, what benefit are you actually getting from making an IRA contribution? Because it's going to reduce your tax liability, but you're not actually paying that tax liability, right? So
what happens is you're putting in effectively post-tax money, right?
Exactly. So that pre-tax contribution effectively becomes a post-tax contribution, right? So, and there are ways to kind of navigate that. You can, file a form with the IRS to notify them that you are not claiming a tax deduction and things of that nature. But that's kind of a separate discussion. The bottom line is you are not getting the main benefit of making an IRA contribution, which is to reduce your current tax liability for that year. And if you are just going through the motion and making that contribution, claiming it on your U.S. taxes without deriving any benefit, the only thing that's going to happen is you're going to increase the amount of unused foreign tax credits that you're going to have at the end of the year, and you've effectively made a post-tax contribution. And then if on top of it you get taxed on the withdrawal 20 years later, then you've effectively double taxed yourself, right? Because you are now paying 100% tax on a withdrawal, so paying tax on 100% of the withdrawal when that contribution had effectively been made on a after-tax basis. So that's a terrible outcome. And yet it happens a lot. We see it all the time. And if you were an American just used to saving and claiming your tax deduction and doing it even after you moved abroad, you could easily find yourself in that situation. And it's
the one time where it would make sense for an American expat is, say you're living in a lower tax jurisdiction than the U.S. and you do have a U.S. tax bill. So, Western Europe is out of the question, but many other stretches of the world, that becomes a good place. Or, you're working and earning, say, in Portugal.
Right.
Then it becomes an option because Portugal has now this new sort of tax regime and lower tax rates for expats there and so on. So from that perspective, now, if I'm going to be making an after-tax contribution, I make $100,000. Why can't I make a Roth contribution?
Well, so potentially you can make a Roth contribution, right? But so the Roth contribution
well, before we get to the potential, I would say it's for the same reason you don't want to make the traditional, because chances are if you're making $100,000, you're using the Foreign Earned Income Exclusion. According to the U.S., essentially, if you're making that $100,000 outside of the U.S., you're making zero.
Exactly.
And the contribution limits for a Roth are $6,000 or however much money you make. So what you frequently see, for instance, is teenagers, right, with the help of their parents, probably make $4,500 at McDonald's over the summer, and mom and dad go and put $4,500 into a Roth IRA for them, right, and cover that, and that's how much you can make. So you have to have, again, for a Roth, the limits are either how much money you're making in the U.S. or $6,000. So that's the first hurdle we have to get by.
And it's the same as with the IRA. You need to have earned income, and it can't have been excluded under the Foreign Earned Income Exclusion, right? So again, for an expat, that could be the first hurdle, is maybe you've excluded the entirety of your earned income and you're not eligible to contribute. It's that simple. Now, the other issue with the Roth is there is a income limit, so an upper limit on it's based on modified adjusted gross income. So there's a level of modified adjusted gross income above which you're no longer allowed to contribute to a Roth. And it's
$144,000 for 2022. It was $140,000 for 2021 if you're married filing singly. So I'm working in the U.S. Say I'm in that situation where I make $200,000, just me solo.
Yeah.
I wouldn't be able to contribute to a Roth IRA living in the U.S. And if you're married and filing jointly, it's under 208 for 2021 and 214 for 2022.
Right.
So again, there's the situation where I couldn't contribute to a Roth.
Right.
And
the other thing about being an expat and wanting to contribute to a Roth is that this upper limit in terms of income, the way that it is defined based on the modified adjusted gross income, one of the modification that takes place is that any amount that you would have previously excluded under the Foreign Earned Income Exclusion is effectively brought back into that calculation, right? So it's not, you couldn't be thinking in terms of, I made, $250,000 or whatever it happens to be, and then I'm only excluding $112,000, and so the difference above that, I'm still within the Roth limit. That's not how it works. The way that it works for the purposes of calculating the modified adjusted gross income is you bring those excluded amounts back in. So if you take the example of a single filer, if they excluded $112,000 from their taxes under the Foreign Earned Income Exclusion, they have to then put that back into the calculation when they assess whether or not they get to that upper limit. And if the upper limit is $145,000, I think we said for
144,
144. So
why would they use 145? That'd be a nice round number.
Just too easy.
Yeah.
So what we're left with in practice here is a very narrow band of income that would allow you to qualify, because you would need to have income above that 112,000 threshold, because you need to have earned income in order to meet the minimum requirement to be able to make any sort of contribution. So having that earned income that has not been excluded. But then when it comes to making an assessment of the upper limit for your income, you have to bring that back in, and it can't be over 144,000. So you have to be within that 112,000 to 144,000 in order to have any opportunity to make any sort of Roth contribution. So it does get tricky, and it really narrows the range of opportunities here in terms of being able to just qualify for making a Roth contribution. So these are the things you need to think about as an expat.
Yeah, and this is just on the front end in terms of the Roth contributions, because and there are other things to consider with the Roth. Is the Roth covered under the tax treaty of the country that you're working with? How does the country that you're in treat the Roth, right? And one of the notorious examples is the Netherlands does not treat the Roth as a retirement account. In fact, that they tax it on an ongoing basis. They don't treat it like they treat a traditional IRA or a pension. Certain countries, if you withdraw money from a Roth, they're not gonna give it to you tax free. They're gonna tax you on it and treat it like a Roth, like a traditional IRA. So again, all those benefits go away.
Absolutely, and I think it's a very important point, and you need to ask yourself, and to some extent, even within the IRA. The IRA is usually a little bit more straightforward, but still, you always need to ask yourself, how is my country of residence going to look at this IRA asset that I have, and would they treat it differently than the U.S. might? So that's always very important, and it can get complicated for the IRA. It can get a lot more complicated with the Roth, and I would say the Roth has this unique provision in the U.S. that it is you can take tax exempt withdrawals after a certain age, after 59 and a half. And that's a great benefit because you make an after-tax contribution, but then the growth is tax free, and then the withdrawals are tax free after once you're in retirement after 59 and a half. So that's a great benefit, but that's a benefit that's only available to you under the U.S. tax code. There is no requirement for any foreign country to honor that provision. So you always need to ask yourself, is that tax exempt withdrawal that I'm hoping to achieve with the Roth, is it actually going to materialize for me given that I live outside the US? And in some cases it might, and in some cases there may be benefits that are available to you under the terms of a particular tax treaty. But most treaties around the world, I think the US has 75 or 77 or so tax treaties with different countries around the world. Most of them don't mention the word Roth. Most of them don't have a specific provision that may apply to Roths. So, the tax treatment of a Roth account outside the US is a complicated topic, and it needs to be really it's a case-by-case thing. Really, you need to figure it out.
Yeah, and so what I would say, a lot of what we do is answer the question for people who call in, can I contribute? And then analyze the question, do I want to contribute? And
exactly.
There are so many permutations on the do I want to that we couldn't run through all of the possible kind of decision trees. So can you? Yes. Should you? Maybe.
Exactly.
To some, for the too long didn't read folks out there.
Absolutely.
That's what we would look at. So
exactly.
We'll definitely be talking more about these topics on Dame la Verdad. Give me some truth. Dime la Vérité, our foreign version of Give Me Some Truth here. But thanks for listening, and look forward. If you have questions, reach out to us via email. We'd love to hear them.
Walkner Condon Financial Advisors is a registered investment advisor with the SEC. Registration with the SEC does not imply a certain level of skill or training. The opinions expressed by the participants of this podcast are their own and do not reflect the opinions of Walkner Condon Financial Advisors. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance. Thanks for listening, and for further information, please visit walknercondon.com.